The last time trade wars escalated, the Great Depression, after the 1930 Smoot-Hawley Tariff Act, followed. That single move, meant to protect American jobs and industries, triggered a global chain reaction. Retaliatory tariffs, collapsing trade, and a stock market crash that wiped out nearly 90% of the Dow Jones between 1929 and 1932. Now, Trump's tariffs echo those same protectionistic policies, raising the question, could history be repeating itself? Warren Buffett is watching these developments closely and making moves in his portfolio. You're about to learn what this means for your money and how to prepare before it's too late. Are you ready to shield your portfolio if history repeats? Let's break down how one policy can reshape the economic landscape and what you can do about it. Why do trade wars have such a powerful impact on the economy? To understand this, look back at the 1930s. The US passed the Smoot-Hawley Tariff Act, imposing high tariffs on foreign goods in an effort to protect American jobs and industries. The plan seemed straightforward: make imported products more expensive so Americans would buy domestic. But that move triggered a global backlash. Other countries responded with their own tariffs on American exports. The result was a dramatic contraction in global trade, rising prices, and an economic downturn that spiraled into the Great Depression. Fast forward to today, and you'll notice striking similarities. Trump's America First agenda brought tariffs on imports from China, the European Union, Canada, and Mexico. These measures were supposed to boost US manufacturing and safeguard jobs. But just like in the 1930s, these policies didn't operate in isolation. When tariffs hit, prices climb, on everything from raw materials to electronics and clothing. Businesses face higher costs, and those increases often get passed right on to consumers at the checkout. Margins shrink, investments slow, and in some cases, companies are forced to lay off workers. Global supply chains add another layer of complexity. Many businesses depend on parts and materials from around the world. When tariffs disrupt these links, costs ripple through entire industries. Companies must either absorb the extra expense, cut production, or raise prices. No matter the choice, the economy feels the impact. And since 1970, our economy is consumer-driven. Even small price hikes can push the US towards recession. Buffett warned, tariffs are an act of war to some degree. He's watched for decades how trade disruptions can undermine economic stability. When companies face uncertainty about future costs or market access, they tend to pull back on hiring, expansion, and innovation. That hesitation ripples outward, affecting workers, suppliers, and even local communities. Consumer confidence is especially vulnerable during these times. If people see headlines about rising prices, trade disputes, or unstable markets, they start to worry. Instead of making big purchases or investing in the stock market, they might hold off, waiting for more stability. When millions of households do this at once, the slowdown becomes real. Businesses sell less, growth stalls, and the risk of recession increases. Warren Buffett has always been a strong supporter of international trade, arguing that open markets benefit everyone in the long run. He cautions against policies that disrupt established trade relationships, emphasizing that repairing trust between trading partners can take years. The damage isn't just immediate, it can linger, making recovery slow and uncertain. Some analysts argue these disruptions could be intentional leverage tactics. Buffett's shift to cash shows he's not taking chances. Recently, he's moved significant amounts of capital into liquid assets, a sign that he's preparing for possible market instability. He's not betting on a quick resolution. The lessons from history are clear. Trade wars don't just affect numbers on a chart. They touch every part of the economy, from paychecks to retirement accounts. Investors know that uncertainty can be just as damaging as bad news. And when the world's largest economy is caught in a trade conflict, the effects are felt everywhere. But trade policy isn't the only factor unsettling the markets. When alliances and global relationships start to shift, another layer of uncertainty emerges, one that keeps investors up at night. Power struggles between nations aren't just a matter of politics. They reshape entire markets. When the US signals it might step back from its global leadership role, especially in alliances like NATO, investors take notice fast. Trump's approach to NATO marked a sharp break from tradition. He demanded that member nations boost defense spending and openly questioned whether the US would defend countries that didn't meet their financial commitments. That uncertainty shook global markets. NATO has long been a foundation of stability in the West, so any suggestion that the US might withdraw or reduce support instantly raises the stakes for investors. When the rules of the global game start to look uncertain, people with money in the markets pay close attention. Unpredictable alliances create a power vacuum. When old partnerships weaken, there's room for new players, like Russia or China, to assert themselves. For markets, this means more volatility. Investors know that instability can disrupt trade, fuel military buildups, and even trigger conflict. It's not just theory, you see it in the numbers. Defense contractors like General Dynamics, RTX Corporation, and Lockheed Martin often see their stocks climb during periods of global tension. That's because governments respond to uncertainty by increasing defense budgets, buying more military equipment, and investing in security infrastructure. Even during Trump's NATO disputes, European and Asian governments began reassessing their own defense strategies, driving up demand for these companies' products. Warren Buffett's investment strategy reflects this reality. He's not making a statement about war. He's recognizing how markets behave when the world feels less stable. Buffett has positioned Berkshire Hathaway with stakes in General Dynamics and RTX Corporation, understanding that demand for defense systems and cybersecurity rises as geopolitical tensions grow. He's seen this pattern repeat over the decades. When global order is questioned, industries linked to security and defense often outperform. Buffett's approach is pragmatic. He positions ahead of the curve, knowing that volatility can create pockets of opportunity even as it unnerves the broader market. But the impact of shifting alliances runs deeper than just defense stocks. When the stability of NATO is in doubt, it threatens the security of trade routes across Europe. Businesses that once relied on predictable logistics suddenly face the risk of disruptions. If political tensions escalate, shipping costs can spike, supply chains get tangled, and inflation creeps higher. Companies become cautious, often delaying investments or expansion, which slows economic growth. Even the fear of disruption can freeze decision-making in boardrooms and on trading floors alike. In Ukraine, sanctions drove European energy costs sky high, showing how conflict hits both hard data and sentiment. The war didn't just disrupt oil and gas supplies, it sent shockwaves through global markets, altering shipping patterns, trade flows, and investor confidence. When investors see instability on this scale, they don't just worry about immediate losses. They look for industries poised to benefit from the new reality. That's why sectors like energy production, weapons manufacturing, and cybersecurity often see surges in demand. Trump's overall strategy may be more calculated than it appears. By introducing volatility into global alliances, he creates leverage. Allies and adversaries are forced to renegotiate terms, sometimes making concessions to regain a sense of certainty. This tactic can bring short-term advantages, but it also injects lasting uncertainty into the markets. Economic shockwaves don't move in a straight line. They ripple outward, affecting everything from supply chains to consumer spending and GDP growth. Buffett's response remains measured. He doesn't react emotionally. He prepares for scenarios others might overlook. By investing in sectors likely to benefit from disruption, like defense, cybersecurity, and infrastructure, he positions for long-term gains while others hesitate. As alliances continue to shift and rival powers look to fill any void left by the US, the risk for traditional investors increase. China and Russia are already moving to expand their influence, forging new economic partnerships and testing the limits of the current global order. This forces businesses to adapt to new trade conditions, sanctions, and currency risks, each sector adding another layer of complexity to investment decisions. So when alliances wobble, which industries will surge, and how can you be positioned? When economic policies start shaking the foundation of global stability, the Federal Reserve often finds itself in the spotlight. During his first term, Donald Trump made his dissatisfaction with the Fed's approach clear, especially when it came to interest rate hikes. He even went so far as to call then Fed Chair Jerome Powell an enemy of the state for raising rates, underscoring just how much he valued lower borrowing costs. Trump's focus was always on economic growth and margin gains. But what if instability itself could be used as a tool to achieve these goals? The Feds tend to cut rates when markets sour or growth stalls, aiming to spur borrowing and spending. This is where Trump's strategies, like sudden tax cuts, trade wars, and ambitious but unfunded infrastructure proposals, come into play. While these moves can create a short-term boost, they also risk introducing the kind of volatility that makes the Fed more likely to step in with rate cuts. For example, massive tax cuts balloon deficits, adding another layer of economic strain that can pressure the Fed. Trade tensions and unpredictable policies further amplify uncertainty, shaking investor confidence and slowing business investment. All of this can create the exact conditions that force the Fed's hand. Warren Buffett's take on this dynamic is clear. Buffett likens ultra-low rates to financial gravity being turned off, warning they distort valuations. When money is cheap, companies borrow more, investors chase riskier assets, and stock prices climb beyond what's sustainable. This environment fuels bubbles, whether in real estate, equities, or consumer credit, because the true cost of capital is hidden. Buffett has seen how these bubbles inevitably burst, often with painful consequences for everyday investors. Trump's preference for ultra-low rates isn't just about economic optics. It's rooted in his background as a real estate developer, where cheap financing turns marginal projects into profitable ventures. Lower rates make it easier to refinance debt, expand holdings, and generate returns. Politically, a strong stock market and robust consumer spending are metrics he can point to as signs of success. But on a national scale, pushing rates down too far or too fast magnifies risks. Companies take on debt they may not be able to repay if rates rise or the economy slows. Entire sectors become vulnerable, and the chance of a market correction grows. The idea of strategic chaos suggests that policy-induced instability may not be accidental. By creating uncertainty through trade disputes, ballooning deficits, or unpredictable alliances, a leader could put pressure on the Fed to act. Lower rates then become both a political and financial win. They can stimulate the economy ahead of an election and support personal business interests tied to real estate and debt. For the broader economy, though, this approach is a double-edged sword. The short-term gains from easy money come with long-term risks of bubble and insecurity. Buffett's warnings about ultra-low rates aren't just theoretical. He's watched as market valuations become unmoored from reality and as risk-taking increases across the board. When rates are artificially suppressed, the eventual corrections can be severe, catching investors off guard and wiping out years of gains. That's why Buffett's strategy is rooted in caution and preparation, rather than chasing short-term trends. With these levers in motion, you need a plan to navigate the fallout. Next, we'll see how Buffett's approach offers that roadmap. In March 2020, when markets crashed, Buffett was buying. What did he do? And what can you copy? Turning chaos into opportunity is at the core of his playbook, and it starts with the basics. Aim for 3 to 6 months of expenses so you don't have to sell low. This simple step gives you breathing room when markets drop, and it keeps you from making panic-driven decisions that lock in losses. Next, take a page from Buffett's disciplined approach, dollar cost averaging. For instance, setting aside $200 bi-weekly means you buy more shares when prices slump and fewer when they peak. This method helps you avoid the impossible task of timing the market. Over time, your average cost per share goes down and you're always participating, regardless of headlines or volatility. Buffett's strategy isn't about reacting to every dip, but about sticking to a plan that lets you capitalize when others are fearful. Market downturns can look like disasters, but they're often clearance sales on quality businesses. Buffett's mantra? Be fearful when others are greedy and greedy when others are fearful. Applies here. When panic selling drags down even solid companies, he sees value. That's why in the midst of market chaos, he's looking for strong fundamentals, companies with steady cash flows, durable brands, and a history of weathering storms. If you're prepared, you can do the same, buying into great businesses at prices that set you up for long-term gains. When considering what to buy, look for areas that thrive on uncertainty. Consider defense names like RTX, then watch growth areas like tech when rates fall. Defense contractors often benefit during geopolitical tension as governments ramp up spending. At the same time, falling interest rates make it easier for tech and real estate companies to expand, pushing their valuations higher as the economy recovers. Buffett's own investments reflect this balance. He holds stakes in defense and growth sectors, positioning for both stability and upside. Diversification is another Buffett hallmark. Don't put all your eggs in one basket, especially when markets are unpredictable. Add dividend payers like Johnson & Johnson, short-term treasuries, a dash of crypto, and even some forex exposure if you can manage the risk. Dividend stocks provide income even when prices fall. Short-term treasuries offer stability when volatility spikes. Crypto and foreign currencies can hedge against weakness in the dollar or traditional markets, giving your portfolio more resilience. The goal isn't to chase every trend, but to build a mix that can absorb shocks and still grow. Buffett's long-term perspective is what gives him an edge. He doesn't sweat daily swings if the underlying company is strong. Take Coca-Cola, one of his signature holdings. It's not a flashy stock, but it's reliable, global, and consistently profitable. That's the kind of business he's comfortable owning through any cycle. For individual investors, the lesson is clear. Focus on companies you trust to outlast a downturn, not just those riding the latest wave. Patience is another advantage you can adopt. Markets move in unpredictable cycles, and trying to guess the bottom or top is a losing game for most. Instead, focus on habits that keep you invested for the long haul. Maintaining an emergency fund, sticking with dollar cost averaging, and keeping your portfolio diversified. These habits aren't glamorous, but they're what let you stay steady while others are reacting to noise. Market chaos isn't just something to survive, it's a moment to build. With a plan in place, volatility becomes a source of potential, not just risk. You get the chance to reassess your approach, reposition your investments, and set yourself up for future success. Remember, the best chance to deploy capital is when things are going down. That mindset turns chaos into potential. Strategic chaos can feel overwhelming, but it's also a moment to assess, reset, and reposition. As Warren Buffett famously said, the best chance to deploy capital is when things are going down. Times of uncertainty aren't a reason to panic. They're a chance to build a solid financial foundation and position yourself for what comes next. Focus on the basics. Create an emergency fund, stick to a long-term plan, and pay attention to company fundamentals instead of daily headlines. If you found these insights helpful, hit subscribe and let us know in the comments. How are you preparing for market volatility? For more practical ideas, check out our video on Buffett's 2025 crash-proof bets. Link on screen.